Welcome to our comprehensive guide to Forex trading technical analysis. In this video, we will explore various concepts and techniques that traders employ to analyze and predict price movements in the foreign exchange market. Whether you're a novice or experienced trader, this guide will provide you with valuable insights to enhance your trading strategy. Let's get started. Introduction to Forex Trading Technical Analysis. Before we dive into the intricacies of technical analysis, let's begin with a brief overview. Forex trading technical analysis is a method of analyzing historical price data and identifying patterns or trends that can indicate potential future price movements. This analysis is based on the belief that history tends to repeat itself, and patterns in price behavior can be used to make informed trading decisions. Key concepts in technical analysis. 1. Candlestick patterns. A candlestick is a way of displaying information about an asset's price movement. Candlestick charts are one of the most popular and fundamental components of technical analysis, enabling traders to interpret price information quickly and from just a few price bars. These visual representations of price fluctuations provide valuable insight into market sentiment and potential trend reversals. Some common candlestick patterns include doji, engulfing patterns, and hammer. 2. Support and resistance levels. Support and resistance levels are price thresholds where the buying or selling pressure becomes significant. Resistance levels occur when there's an upward trend in the market and the price decreases and moves towards the trend line. On the hand, support levels form when there's a downward trend in the market and the prices move towards the trend line. These levels are identified by analyzing historical price data and are often considered areas of potential trend reversals. Traders use support and resistance levels to determine entry and exit points. 3. Moving averages. A moving average is simply a way to smooth out price fluctuations to help you distinguish between typical market noise and the actual trend direction. A moving average, MA, is a mean average continuously calculated over a specified time period. Moving averages are statistical calculations that smooth out price fluctuations over a specified period. They are commonly used to identify trends and potential trend reversals. Popular types of moving averages include simple moving averages, exponential moving averages, and weighted moving averages. Technical indicators for Forex trading. 1. Relative Strength Index, RSI. The Relative Strength Index is a momentum oscillator that measures overbought and oversold conditions. It helps traders assess the strength and speed of price movements, aiding them in making informed decisions on when to buy or sell. The Relative Strength Index, RSI, is most commonly used to indicate temporarily overbought or oversold conditions in a market. An intraday Forex trading strategy can be devised to take advantage of indications from the RSI that a market is overextended and therefore likely to retrace. The RSI is a widely used technical indicator and an oscillator that indicates a market is overbought when the RSI value is over 70 and indicates oversold conditions when RSI readings are under 30. 2. Moving Average Convergence Divergence, MACD. Moving Average Convergence Divergence, MACD, or MACD, is a trend-following momentum indicator that shows the relationship between two exponential moving averages, EMAs, of a security's price. MACD is a popular and versatile indicator that combines moving averages to identify potential trend reversals. By analyzing the relationship between the MACD line and the signal line, traders can gain insights into buying and selling opportunities. 3. Bollinger Bands. Bollinger Bands are a form of technical analysis that traders use to plot trend lines that are two standard deviations away from the simple moving average price of a security. The goal is to help a trader know when to enter or exit a position by identifying when an asset has been overbought or oversold. Bollinger Bands consist of a simple moving average, with upper and lower bands representing two standard deviations from the moving average. They are widely used to identify periods of high or low volatility. When the price approaches the bands, it may signal a potential trend reversal. Creating a trading strategy with technical analysis. 1. Timeframe selection. Choosing the right timeframe is crucial for effective technical analysis. Shorter timeframes provide more granular details, while longer timeframes offer a broader perspective. Traders must align their preferred trading style with the appropriate timeframe. Most traders will start by choosing one longer timeframe and another shorter timeframe. As a general rule, traders use a ratio of 1:4 or 1:6 when performing multiple timeframe analysis, where a 4 or 6 hour chart is used as the longer timeframe, and a 1 hour chart is used as the lower timeframe. 2. Technical analysis in conjunction with fundamental analysis. Combining the strengths of the technical analysis and fundamental strategies can help investors better understand the markets and gauge the direction in which their investments might be headed. While technical analysis focuses on price patterns and indicators, fundamental analysis involves evaluating economic, political, and social factors that influence currency values. A comprehensive trading strategy may use a combination of both approaches. Technical analysis is a powerful tool used by Forex traders worldwide to make informed trading decisions. Remember, it is essential to complement technical analysis with risk management strategies and a thorough understanding of market fundamentals. We hope this video has provided you with a solid foundation to enhance your Forex trading technical analysis skills. Happy trading! Don't forget to subscribe, like and share this video for more trading tips and Forex courses.